Okay, so everyone thinks they know Benjamin Graham, right? The father of value investing. But what if I told you the official story isn't the whole story? We're about to uncover a secret that could completely change how you think about one of the biggest legends on Wall Street.
We've all heard his famous mantra. It's the absolute cornerstone of his philosophy, the margin of safety. The idea is simple, but it's incredibly powerful. Buy stuff for less than it's actually worth. It is the bedrock of value investing.
But, and this is a big but, here's the paradox that kicks off our entire investigation. The man who is literally synonymous with the word value actually made more money from one single growth stock than from all of his other investments combined.
Whoa, hold on a second. That can't be right. The man who wrote the literal book on value investing made his biggest score on a growth stock? I mean, that goes against everything he famously taught. There has to be more to this.
Oh, it's true. And to really understand how, we need to follow the evidence, just like any good detective story. So here's our case file. This is the roadmap we're going to use to uncover the truth. All right, so before we get into the weeds, let's establish the official story. Who was the Benjamin Graham we all think we know? He was the master of discipline, a professor, an author. He was the guy who tried to turn the Wild West of the stock market into an actual science. He gave us a framework based on cold, hard analysis, not just wild hunches. And yet, this one single fact just completely turns that entire profile on its head. His biggest win, his Grand Slam home run, came from breaking what we all thought were his own rules. So how in the world do we solve this contradiction? Well, the key piece of evidence was published way back in 1962, but then it mysteriously vanished. And the clue wasn't in some old, forgotten diary. No, it was hiding in plain sight, right inside his most famous book, Security Analysis. But here's the crazy part. It was in a chapter that was completely scrubbed from every single edition published after he died. Wait a minute. You're telling me he wasn't just a value investor? That late in his career, he cooked up a whole different way to look at growth companies? Why would he do that? And more importantly, why would somebody try to hide it? Exactly. That's the million-dollar question. And inside that lost chapter was his secret weapon, a simple, almost beautifully elegant formula designed to find the true value of a growth stock. And this just brilliantly shows you the logic. Think of it this way. The formula starts with a baseline price-to-earnings ratio, a PE, of 8.5 for a company that has zero growth, a complete snoozer. Then, for every little bit of expected growth, it adds a premium. It's a system for valuing the future. Okay, I see how the math works. It's pretty straightforward. But I don't know, this just feels risky. How does this fit in with his most important principle of all? That is the crucial question, isn't it? And it's the answer to that question that separates this from just being reckless speculation. So let's really dig in and see how Graham built a margin of safety into this growth-focused idea. Exactly my point. The whole concept of a margin of safety is based on tangible, real, present-day value, not some optimistic guess about what might happen years from now. And Graham himself actually answered this. He argued that safety doesn't only come from buying below today's value. He said it can also come from paying a disciplined, reasonable price for future earnings, as long as you are conservative about estimating those future earnings. A theory is one thing, but let's see if this secret formula actually holds up in the real world, like during a completely irrational market bubble. So let's examine the crime scene. Cisco Systems, right in the middle of the dot-com mania. The market was absolutely euphoric. People thought the stock could only go up. So let's be crystal clear about this. While the market, in its collective madness, was happily paying $82 a share, Graham's formula was quietly whispering that the stock was only worth $17. It was a massive, blaring warning sign that almost everyone just completely ignored. And this right here, this is the definitive evidence. It's the smoking gun. If you chart the stock's actual price against the value that Graham's formula spit out, you see something amazing. The formula would have kept you safe from the bubble, and it would have even signaled the exact moment the stock became a bargain after the crash. It was like a clear map through all that madness. So the evidence is in. The case is closed. Graham wasn't just a value investor. He was a disciplined investor, period. And he developed a powerful tool that you could use in any market situation for pretty much any type of company. So what's the verdict from our little investigation? Well, we've basically uncovered a lost piece of financial history, a disciplined framework for investing in growth from the most unlikely source imaginable. And this isn't just some historical fun fact. It's a practical tool you can use.
And this all leaves us with one final, kind of provocative thought. If the father of value himself had a secret life as a growth investor, what other settled market truths out there are just waiting to be questioned? It just goes to show you, even the most established wisdom deserves a second look.